Everybody, I am ready to start chapter 2. This is a fun chapter where we talk about job order costing. So again, we're in managerial accounting, and oftentimes we contrast the job order costing with process costing. Job order costing is very common and used when what's being manufactured are a lot of different products each period. Products are manufactured to order. The unique nature of each order requires tracing and assigning costs to each job and maintaining cost records for each job. So I always think of with job order costing like homes, building homes. Each home is going to have unique items just for that specific home. So it's important for companies to keep track of those specific costs assigned to each home. I mean, and you could do it in a variety of even, one-of-a-kind items. Same with automobiles. Some automobiles might have leather seats, others have the cloth. Examples of companies that would use job order costing include Boeing, who manufacture aircraft, a large construction company, or Walt Disney movie production. Although Walt Disney's kind of hurting right now, I heard. Are they losing money? So we talked last week the difference between indirect and direct costs. We know that in job order costing, you will need to assign the direct materials and the direct labor to each specific job. Charge direct material and direct labor costs to each job as the work is being performed. Then the manufacturing overhead, which includes the indirect materials and indirect labor, get allocated to all jobs rather than directly traced to each job. And if you think about it, we talked last week, there's so many indirect costs. There's no way you can assign them to jobs. So we've got to come up with some type of format to allocate those indirect costs to jobs. So those indirect costs by some formula will be assigned to the various jobs. You see here a job cost sheet. So in here, it gives you the job number, which department, what item, and the direct materials and direct labor that are linked to this particular job order. The material requisition, when they request for materials, they have to specifically identify with the requisition what job they're being attached to and what items. So in here, you've got 2 quantity of M46 housing and then 4 items of some connector. Those get assigned specifically to that job when they're being requisitioned. In here, there it looks like milling March 2nd, special order coupling. Yeah, it's just showing that they get added to that specific cost sheet. Now, in terms of labor costs, those direct labors will also be linked to a specific job. So here, when you see this Mary, the employee's time ticket, she shows how many hours she's spending on each job, okay? And then upon that, that will get transferred to those jobs. Okay, so what we're going, yes. the overhead gets assigned to jobs based on some method. It could be machine hours. It could be um, labor hours. No, there's not one standard at all. Each department determines how much per hour based on past history. And then once they determine what the actual overhead rate or the amount truly were, then it gets applied back. That's going to be something we're going to talk about in length in another chapter. I don't believe it's this chapter, but it is more involved. The tough thing with overhead is it's a big figure, and there's got to be some type of way in which we allocate it. And because the costs come in after the fact, we've got to do the best we can to allocate it up front and then determine any under or over applied, we credit back. So we have to come up with, for manufacturing overhead, a predetermined rate. So I think we'll be discussing a good bit of this. How do we come up with a predetermined rate? We have to find some type of allocation. So for example, if an automobile, if it makes more sense to use direct hours associated with an automobile or maybe machine hours, we've got to come up with a manner in which we assign that overhead to specific jobs. Use an allocation base because it's impossible to trace overhead costs to particular jobs. Manufacturing overhead consists of many different items, ranging from grease to a production manager to the cafeteria. Many types of manufacturing overhead costs are fixed, even though output can fluctuate during the period. So there's just so much that goes into that. We've got to find a way in which to allocate it. The predetermined overhead rate used to apply overhead to jobs gets determined before the period even begins. So we need to use past history in order to come up with a reasonable approach for determining this allocation. Probably if it's a new company, somebody in that company has some experience in the field, and so they're going to come up with the best rate possible and then fine tune that. So as you see here, the predetermined overhead rate is equal to the estimated total manufacturing overhead for the coming period divided by the estimated total units. So this is all estimate divided by estimate. Ideally, the allocation base is what we call the cost driver, that which drives the cost. Okay? So predetermined overhead rates that rely upon estimated data are often used because we don't know the actual overhead until the end of the period. So we can't estimate jobs with actual because we don't even know what the actual is going to be. Actual overhead costs can fluctuate, ultimately giving answers we just don't even know what could. There's so many unknowns. We got to come up with the best determination. So how do we go about computing them? We do this all before the period begins. We estimate the total amount of the allocation base that will be required for next period's estimated level of production, which is the denominator, the bottom number. Estimate the total fixed manufacturing overhead costs for the coming period and the variable manufacturing overhead costs per unit of the allocation base, and then use this equation to estimate the total amount of manufacturing overhead. So Y is the total manufacturing overhead cost will equal the total fixed manufacturing plus the estimated variable times some allocation base. Okay? From that, that's how we're going to compute it. So here's an example. Harris Fabrics computes its plant-wide predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 20,000 direct labor hours would be required for the period's estimated level of production. The company also estimated 94,000 of fixed manufacturing overhead costs for the coming period and variable manufacturing overhead of $2 per direct labor hour. Harris's actual manufacturing overhead cost for the year was $123,900, and its actual total direct labor hours was 21,000. So when we determine the predetermined overhead rate, we're using estimated numbers, correct? So you see how sometimes they give you stuff you're not needing? So in order to compute the estimated, we're doing the estimated fixed manufacturing overhead of 94,000. Then the estimated variable manufacturing overhead is going to be $2 per hour. You see that $2 per hour times 20,000 estimated direct labor hours. So we've got 134,000 total costs that we're estimating. Divide that by our estimated direct labor hours, gives us $6.70 per direct labor hour. Does that make sense, guys? Estimated divided by estimated. Now, we're going to apply this overhead to jobs using this predetermined rate, such as what we just figured out. Yoast Precision estimates it's going to require 40,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates total fixed manufacturing overhead at 640,000 and variable manufacturing overhead costs at $4 per direct labor hour. So you see how we come up with the estimated fixed times the estimated direct labor hours times the variable manufacturing overhead cost of $4 gives us our $800,000 total manufacturing overhead. You divide that by the cost driver, in this case the 40,000 labor hours, to give you $20 per labor hour. Okay? So you see here, we show 27 hours because the direct labor in this particular job was 27 hours. We take that actual 27 hours times the estimated direct labor to apply that $540 to this job. Does that make sense? Yes? No? Okay. Here's another example. Luthen uses a plant-wide predetermined overhead rate of $23.40 per direct labor hour. This predetermined rate was based on a cost formula that estimated the total manufacturing overhead of $257,400. But the company incurred actual total manufacturing overhead costs of $249,000 and $10,800 total direct labor hours. How would we determine the amount of manufacturing overhead costs that would have been applied to all jobs during the period? How do we figure this out? We take, because when we apply them, we use actual labor hours times our predetermined overhead rate. So in this example, we would apply actual direct labor hours of 10,800 times our predetermined rate of 2340. So we would have applied 252,720. And you see what we estimated the predetermined rate based on total manufacturing overhead is 257,400. Why? So we underestimated, or we underapplied it, because we estimated 11,000 direct labor hours when in fact we only had 10,800 direct labor hours. There's so many different facets to come into these numbers. We're always going to be over applying or under applying. And we fix it after the fact. Does that make sense? Now, compute the total cost and the unit product cost of a job using a plant-wide predetermined overhead rate. So basically, we're going to get better results when we use department-wide, but in this case, the plant-wide, as you see, will show the, let me see here, compute the total unit cost using the plant-wide. So basically what we're doing here, I'm sorry I put this in here twice, we're basically showing the plant-wide overhead rate was given. We take that times our actual direct labor hours to come up with what we're applying for the manufacturing overhead. Okay? Take a look at this, guys. Let's see if you guys can answer this one. Job WR53 required $200 of direct materials, 10 direct labor hours at 15 bucks per hour. Estimated total overhead for the year was 760,000, and estimated direct labor hours were 20,000. What would be recorded as the job cost of job WR53? What we're wanting to know is what goes into this cost is direct materials plus direct labor plus manufacturing overhead. What are all those amounts together? We know the direct materials is 200. We know the direct labor is 150. So what will be the manufacturing overhead? Okay, that's what we're asking. Anyone? 1 second here. I'm uploading the video. Sorry. Anyone have an answer? C. How many agree with C? So look at this. We're going to take the way we calculate the predetermined overhead rate is we take estimated by estimated. So the 760,000 divided by the estimated direct labor hours of 20,000, we come up with a rate. We apply it based on actual direct labor hours of 10 hours times that 38 bucks. It gives us our 380. So our direct labor's 200, our direct labor's 150, our direct materials is 200, and our manufacturing overhead we're applying to this job is the 38 times actual labor hours. Does that make sense, guys? How it works? Okay. Inaccurately assigning manufacturing costs to jobs adversely influences planning and decisions made by managers. Job order costing systems can accurately trace direct materials and direct labor right to jobs. That's a given. But they often fail to accurately allocate that manufacturing overhead used during the production process. It's really difficult to do it because there's so many costs going into it and you can't specify a job. So we got to come up with a base. Choosing an allocation base, here's the issue. Sometimes they use allocation bases that don't really reflect how jobs actually use resources. The allocation base in the predetermined overhead rate must drive, it must be the force behind the overhead. A cost driver is a factor that causes overhead costs. Now, these plant-wide rates are often used, but it's simplistic. One, it doesn't always work for all departments. However, it's an overly simplistic and incorrect way to assume that direct labor hours is the only driver for a company. If more than one overhead cost driver can be identified, job cost accuracy is improved by using multiple predetermined overhead rates. So the multiple predetermined overhead rates can be more complicated, but ultimately can be a better barometer for allocating overhead. So as you see here with this service company, Tech Solutions is a consulting firm that uses job order costing. Its direct materials consist of hardware and software that it purchases and installs on behalf of its clients. The firm's direct labor includes salaries of consultants that work at the client's job site, and its overhead consists of costs such as depreciation, utilities, and insurance related to the office headquarters, as well as office supplies. Tech Solutions computes its predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 80,000 direct labor hours would be required for the period's estimated level of client service. The company also estimated 680,000 of fixed overhead costs of the coming period and its variable overhead of 50 cents per direct labor hour. The firm's actual overhead cost for the year is $692, and its actual total direct labor was 83,000 hours. How will we compute the predetermined overhead rate? Let's just do that one first. How are we going to determine it? we're going to do the estimated fixed overhead of 680 times the estimated variable is the 50 cents times the estimated hours of 80,000 direct labor hours. So our overhead cost we're estimating is 720,000. If we take that and divide it by our estimated direct labor hours, that's what we'll use per hour, the $9 per hour. Okay, that's how you come up with that predetermined rate. What's going to get assigned to Xavier? Well, we know the direct materials of 38,000. We know the direct labor of 21,000. And we know the direct labor hours worked are 280 hours. The 280 hours times $9 per hour is what we're assigning as manufacturing overhead to this job. Does that make sense, guys? Yes, no. And again, you don't have to memorize it because you get to have an open book. But at least you understand how the process works. To determine the predetermined overhead rate, you're going to divide estimated by estimated. But what gets applied to the job is always going to be the direct hours on that job times that overhead rate. Okay? Now let's see it happening backwards. Han Company uses a job order costing system. Its plant-wide predetermined overhead rate uses direct labor hours as the allocation base, and the company pays its direct laborers $15 per hour. During the year, the company started and completed only 2 jobs. Job Alpha, which used 54,500 direct labor hours, and Job Omega. The job cost sheets for these 2 jobs are shown below. So basically, it gives us all the information for Job Omega, but we have to fill in the information for Job Alpha. The first thing we have to do is determine the plant-wide predetermined overhead rate. Well, we can figure out the overhead rate because we see with Job Omega the manufacturing overhead applied, and we know, let me see here, direct labor hours as the allocation base, and we see the total costs of the jobs. So if we take the direct labor costs for Job Omega, you see this 345,000? And we can tell how many actual hours were worked because we know it's $15 an hour. So if we take the 345,000, divide that by $15 an hour, we then know how many actual direct labor hours were worked for Job Omega. Can't we take this amount of 184,000 and divide that by actual direct labor hours to come up with how they allocate the predetermined overhead rate? So what we're doing is we're going backwards on this one to figure out what was that predetermined overhead rate. Because if we know the direct labor hours are at $15 an hour, and those we can come up with the actual hours, divide that by the amount applied of manufacturing overhead. So the job cost sheet for Alpha, we know it's going to be $8 an hour, and they told us the actual overhead or the actual direct labor hours are 54,500 hours. So we can take our $8 to come up with the manufacturing overhead. They gave us the 54,500 actual direct labor hours. They also told us it's at $15 an hour, so we can come up with the direct labor also. So the only plug-in, since they gave us the total cost, we can figure out the 436, we can figure out the direct labor, then the plug-in is the direct materials. Make sense? Yes. Okay, let me. Okay, this 23. Okay, so there's two jobs, guys. The job omega, the job alpha. The first thing we have to do is figure out for job omega, it tells us the manufacturing overhead of 184,000. Just for job alpha. So once we figure out the predetermined overhead rate, we can then take that amount times the 54,500 direct labor hours to figure out what our manufacturing overhead is applied. We can figure out our direct labor by 54.5 times $15. So the only thing we plug in then is the direct materials. Okay? Okay. So moving on. Now this is using multiple predetermined overhead rates, not just a company-wide. In order to use multiple predetermined overhead rate, here we've got Dixon. They have two production departments, milling and assembly. The company uses the job order costing system and computes a predetermined overhead rate in each production department. The predetermined overhead rate in the milling department is based on machine hours, and in the assembly department, it's based on direct labor hours. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing costs to establish selling prices for all of its jobs. At the beginning of the year, the company made the following estimates. So these are estimates. Estimated machine hours will be used for the milling department. For assembly department, we're going to use estimated direct labor hours. And do you see why it's more appropriate for milling to use machine hours? Because 60,000 machine hours and there's only 8,000 direct labor hours. So the machine hours truly are the cost driver. It is the cost driver for this department. Whereas in the assembly department, there are very few machine hours where the direct labor hours are the driving force of what causes the costs. So this is a perfect example of why companies need different rates or different types of cost drivers. So as you see here, it gives us the estimated total fixed for both departments and estimated variable manufacturing. During the current month, the company started and completed job 407. It wants to use its predetermined departmental overhead cost and rate for the milling and assembly department. So we see with the milling, we use machine hours times the estimated machine hours plus their fixed manufacturing overhead estimated. Assembly, we're going to use direct labor hours estimated. Okay? Calculate the predetermined overhead rate for each department. The 510 estimated divided by the 60,000 estimated machine hours gives us our $8.50 per machine hour. The assembly department, the 800,000 divided by estimated 80,000 direct labor hours gives us our $10. Okay? That's the predetermined rates. So what are we going to apply to each job? Well, we're going to apply to each job what actually was used. So in this case, the milling actually used 90 machine hours. So we take actual machine hours times the predetermined overhead rate of $8.50 to give us what we're applying from the milling department. And then in this assembly department, we actually use 20 direct labor hours times our overhead rate of 10. So the 200 plus the 765 gives us the $965 that's being applied to this job. Does this make sense, guys? Emily, you're shaking your head? We can use the information given to calculate the amount of the total job cost. We know our direct materials, we calculate our direct labor, and we know what our manufacturing overhead is. So we've got the figures we need. Okay? Then once we know our total cost, we can mark it up to figure out what we're going to sell it for. So if there's a 75% markup, we take our costs, we multiply it times 75%, and we add the two together. In this case, if we use a departmental overhead application, this is what we come up with. If they used a company-wide or plant-wide rate, we'd be coming up with totally different numbers. Because as you see there, what drives the milling department are machine hours, not overhead hours, okay? Again, let me fix this slide. In this case, Delph uses a job order costing system and has two manufacturing departments, molding and fabrication. The company provides these estimates. So you see, we've got our machine hour estimates, our fixed manufacturing overhead estimates, and then variable overhead costs. During the year, the company had no beginning or ending inventories, and it completed only 2 jobs. Here's the information for job D70 and job C200. So we see here machine hours for the molding department and the machine hours for the fabrication. So we basically have to start by using the departmental predetermined overhead rates, compute the departmental predetermined overhead rate, and manufacturing costs that we're going to assign to each. So let's start with that. In here, we've got our estimated fixed manufacturing overhead times our estimated variable. So for molding, we know our estimated costs are going to be $760,000. Divide that by our estimated machine hours, means in the molding department, we're going to assign $38 per machine hour. Now in the fab department, they estimated our fixed. We estimate $1 per machine hour at 30,000 machine hours to come up with a $240,000 estimated total manufacturing. Dividing that by our estimated hours gives us $8 per machine hour, the predetermined rate. Then from there, we need to assign it based on actual machine hours. So we get our direct materials, we get our direct labor, we take our actual machine hours for the molding and fab times those predetermined rates to come up with the costs per job. Okay? Now, what do we bid it for? We know based on just what the costs are, and it tells us we mark it up 150%. So the cost times the 150% is what we're going to bid it for. Make sense? Cost of goods sold is equal to the sum of the manufacturing costs assigned to both jobs A and B. So it's going to be the 1,640,000 and the 1,370,000. The total cost of goods is going to be, or manufacturing cost is going to be 3,010,000. Okay. The plant-wide overhead rate of $20 per machine hour is calculated by combining the estimated manufacturing overhead cost computed in 1A for molding and for fabrication, and then dividing it by the estimated total machine hours of 50,000. So if we do it plant-wide, we're going to be doing $20 per machine hour. When we did it this way, we had the fabrication department at $8 per machine hour, and we had the molding department at $38 per machine hour. You see, by doing it by department, you're going to get better figures than assigning a plant-wide rate. You're not going to be as specific. So you see, if we do a plant-wide rate, our costs are going to be considerably different in one department to the other. And as you see here, the cost assigned here, ultimately the total is the same. It's just the difference between the two jobs are going to look different. Okay. The different bid prices is the key because of the manner in which we're using departmental rates or overhead rates. When a company creates overhead rates based on the activities that it performs, it is employing an approach called activity-based accounting costing, which we're going to talk about in a future chapter. ABC is an alternative approach to developing multiple predetermined overhead rates. That's going to be in another chapter, okay? Now, these cost sheets that we're assigning to jobs, when the job has not been completed and it's still in process, we're going to have to separate out what's still sitting in finished goods versus what has been actually sold. So all of the job cost sheets are in a specific ledger. We call it the subsidiary ledger. And they show where they're at with all the specific jobs. Basically, each job is a little mini set of the costs that have been assigned to those jobs. If the job has not been completed, it's still going to be in that inventory section called work in process. If the job has been completed, it's going to be in an inventory category called finished goods. If the products have been sold, then it's not even going to be in inventory anymore. It's going to be in a cost of goods section on the income statement. The job cost sheets provide an underlying set of financial records, and they explain what specific jobs comprise the amounts reported in the cost of goods sold on the income statement, because we'll see exactly those costs assigned to those jobs, and if they're sold, they're going to be out of the inventory. Know the amount of overhead applied to all jobs during a period is going to differ from the actual amount of overhead incurred during the period. When a company applies less overhead to production that it actually incurs, then we've got underapplied overhead, which means there's more actual cost out there and we didn't apply enough to the jobs. But if we apply more overhead than what actually occurs, then we've overapplied it. We've assigned too many costs to those jobs. We might have charged too much to those specific jobs. So we're always playing catch up. We're just trying to make it the best figures we can. The cost of goods sold reported on a company's income statement must be adjusted to reflect what we've either underapplied or overapplied. The adjustment for underapplied overhead will increase cost of goods sold, which ultimately reduces our net income. But if we've overapplied our manufacturing overhead, then it will decrease. When we adjust it, it will decrease our cost of goods sold, which ultimately increases our net income. So we're playing catch up. We can still do the same thing in service companies, although we might not have specific materials assigned per se, but we can assign costs to jobs in service companies just as we do the manufacturing companies. I would like to take a moment and we're going to work on a homework assignment, okay? And then we're going to let me go back here and get in there. Let's see what we want to do here. Okay, so I want to go through a couple of these just because there's a lot to cover today. Let's look at Speedy Auto Repairs. They use a job order costing. Its direct materials consist of replacement parts installed in customer vehicles, and its direct labor consists of mechanics' hourly wages. Speedy's overhead costs include various items such as the shop manager's salary, depreciation of equipment, utilities, insurance, and magazine subscriptions and refreshments for the waiting room. The company applies all of its overhead costs to jobs based on direct labor hours. At the beginning of the year, it made the following estimates. It estimated 20,000 direct labor hours. It estimated 350,000 of fixed overhead costs. and the variable overhead cost per direct labor hour is $1. What we have to do is determine the predetermined overhead rate. So couldn't we determine the predetermined overhead rate by taking, go back here, the 350,000 plus the 20,000 estimated labor hours times $1, that would be 20,000. So wouldn't the estimated overhead be 370,000? The 350 fixed, the variable is the 20,000 times 1, 20,000 estimated direct labor hours times $1 variable. Total manufacturing overhead should be the combination of 370, but to determine per labor hour, predetermined overhead rate, we would take the 370,000, divide that by 20,000 estimated direct labor hours to come up with $18.50 per direct labor hour. Does that make sense? Yes? No? So we've got this one, compute the overhead rate. This should be $18.50 per direct labor hour. You can check your work. Oops, you've already had this assignment open. I don't know what I just did wrong there. So you can check your work. For $18.50. Okay, so what we're doing here, we have to come up with the total manufacturing overhead. So we came up, it gave us 350,000 of fixed. And then it told us the variable is $1 per direct labor hour. So the estimated 20,000 direct labor hours times $1 a labor hour is 20,000 variable. So our overhead is 370. That 370,000 divided by our estimated labor hours of 20,000, you take the 370 by 20,000, it gives you $18.50 per predetermined overhead rate. Now for requirement 2, it asks us for during the year, Mr. Wilkes brought in his vehicle to replace his brakes, spark plugs, and tires. The following information pertains to his job. The direct materials is the $590. The direct labor cost is $109. And it's telling us the direct labor hours used of 6. We've got to configure out what his cost is. Well, we know the direct materials is $590. It tells us $109 in direct labor hours. The overhead gets applied by actual labor hours, which they said were 6 times the $18.50. The 6 times the $18.50 gives us $111 overhead applied. Wouldn't the cost that is assigned to this job be the $810? Okay? That makes sense? Then amount charged to Mr. Wilkes. Well, we take the $810, and does it tell us what the markup is? If Speedy establishes selling prices using a markup of 40% of its total job, then how much would it have charged Mr. Wilkes? So wouldn't we take the $840, and if we mark it up by 40%, $810 is the markup. 810, sorry, not 840, times the markup of 40%. So this is going to be the 810 times 40%. So wouldn't we charge Mr. Wilkes sorry guys, $11.34? Okay, got it? Is that kind of making sense? Okay. Let's try number 3. Tex something corporation worked on 4 jobs during October. Worked on job A 256, worked on job A 257, job 258, and 260. At the end of October, the job cost sheets for these jobs contained the following data. So it tells us for this job A 256, the beginning balance, the charge to jobs during October in the direct materials, direct labor, and manufacturing overhead, units completed, and units sold. Jobs A256 and 258 were completed during October. The other 2 jobs were incomplete at the end of October. There was no finished goods inventory on October 1st. The company's total manufacturing overhead applied equals its total actual manufacturing overhead, so we don't have to worry about under and over applied manufacturing overhead. What is the cost of goods sold for November? So we see here job A256 sold 80 units and job 258 sold 40 units, right? So the way we're going to figure out these jobs is we've got to figure out how much we're going to apply to each one of these units. So job A256, let me start that first. We'll start with job A256, and then we will work on job A258. Now job A256 tells us the beginning balance was $1,200, and we're going to apply direct materials, direct labor, and manufacturing overhead. So we will take here the beginning balance, okay? That one was $1,200. Then we will add the direct materials, and that is $2,600, and direct labor is $800. Direct materials is going to be $2,600. Direct labor is $800. And the manufacturing overhead is $1,200. So here we've got total costs here. And we did how many units? We completed 100 units, right? So unit cost would be 5,800 divided by 100, or 58 bucks a unit, wouldn't it? So wouldn't, if we sold 80 units, wouldn't it be the 58 times the 80 bucks is what this cost would be for this cost of goods sold for this job? For that job. Let's look at job A258. We started with 0 beginning balance. We had 1,400 of direct materials, 600 of direct labor, 900 of manufacturing overhead. 1,400, 600, 800. Is that right? So this particular job, total units. I'm sorry, did I screw up? Yeah, 1469, and we completed 200 units. And we completed 200 units here. So wouldn't we be, the cost per unit is $14.50 per unit, and we sold 40 units. So if we sold 40 units, wouldn't it be the 40 units times the $14.50 or $580? So our total cost of goods sold should be $4,640 plus the $580, or $5,220. Okay. So how will we calculate the finished goods inventory at the end of October? Well, we know we have 20 units left in finished goods here. We've got 160 units left in finished goods here, don't we? Do you see that? If we sold 40, we've got to have 160 left. If we sold 80, we've got to have 20 units left. So I would say finished goods inventory, it would be the 58 times the 20, or 1160. And this one should be the $14.50 times 140 units. Let me see, did I do that right? 160 units. 160 units. So in our finished goods, wouldn't we have 3,480? That making sense? Now, the work in process, 3,480. The work in process are going to be jobs 257 and jobs 260, right? So the work in process is going to be, we began with 500. We have direct materials, direct labor, and manufacturing overhead. So the 535, that's got to be 6,500 there. And the job A260, it's got to be 4,500. So the 6,500 from job 257, the 4,500 from A260, 65, 45, 11,000. Does that make sense? How we're calculating these? Am I losing you? You know, it's so helpful when we do them together. I'm purposely doing some of these homework assignments through the lecture together just because it slows it down and it kind of makes sense. Let's see what else we can do here. Let's try number 4 here. I am going to let you attempt it on your own for a minute while I run to the bathroom. And then we're going to, again, there was a problem very similar to this that we had on the slides, but we're going to do this. I'll be right back. You guys attempt to start it, okay? Right back. Anyone get any leeway? So, looks like Wilmington, 2 manufacturing departments, assembly and fab. All of its manufacturing overhead costs are fixed. The first set of data shown is based on estimates from the beginning of the year. The second set relates to one particular job completed during the year, job Bravo. So if Wilmington uses a plant-wide predetermined overhead rate based on direct labor hours, how much manufacturing overhead would be applied to job Bravo? So what we need to figure out is we need to come up with a predetermined overhead rate. So if we've got manufacturing overhead of 1,400,000 and we see 80,000 estimated direct labor hours, 140,000 and direct labor hours are 80, did I say? 80,000. Yes. Sorry. Yes, thank you. So it would be the 1,400,000, divide that by our 80, should be $17.50 per the predetermined overhead rate, right? And for job Bravo, wouldn't it be 14 hours times our predetermined overhead rate? 14 hours times the 1750. So wouldn't that be 245? Make sense? Then it asks, manufacturing overhead applied from okay, that was a plant wide. Then if we separate it and do manufacturing overhead from assembly to Bravo, if we do the assembly to Bravo, we've got assembly of $600,000 times 50,000, right? 600,000 times 50,000 is it $12, right? And $12 times 11 is what? 12 times 11 is what, guys? 132. And then from fabrication to Bravo, I'm going to let you guys take a minute and try to figure that one out. Absolutely. Tell me what you guys get for the fabrication department. You got 48. Anyone else? So if you look at fabrication, that 800,000, and they want us to use machine hours because those machine hours are the driving force. So that'd be $8, right? And if we have 6 machine hours, 8 times 6, 48, right? Yeah, because we did it before. But it makes sense why they do machine hours, because that's what's driving the cost. You guys get that? Is it making sense? Okay, let's see what else. We have one. Number 2 seems hard. Okay, we can do 2. Macaulay Hospital uses a job order costing system to assign costs to its patients. I'm sorry, what? A job order costing system to assign costs? Well, think about it. You have to assign costs to patients. If that patient has a certain procedure, that procedure, to x-ray or drugs or whatever, gets assigned to that patient. So when the patient checks out, those are his bills. Does that make sense? Its direct materials include a variety of items such as pharmaceutical drugs, heart valves, artificial hips, and pacemakers. Its direct labor costs, surgeons, anesthesiologists, radiologists, and nurses associated with specific surgical procedures and tests are traced to individual patients. All other costs, such as depreciation of medical equipment, insurance, utilities, incidental medical supplies, and the labor costs associated with around-the-clock monitoring of patients, are treated as overhead costs. Historically, McCullough has used one predetermined overhead rate based on the number of patient days. Each night that a patient spends in the hospital counts as one patient day. To allocate overhead costs to patients, for the most recent period, this predetermined rate was based on 3 estimates. Fixed overhead costs of $17,200,000, variable overhead cost of $110 per patient day, and a denominator volume of 20,000 patient days. Recently, a member of the hospital's accounting staff has suggested using 2 predetermined overhead rates, allocated based on the number of patient days to improve the accuracy of the costs allocated to patients. The first overhead rate would include all overhead costs within the intensive care unit, and the second overhead rate would include all other overhead costs. Information pertaining to these 2 cost pools and 2 of the hospital patients, patient A and patient B, is provided below. So we see the ICU, you've got estimated variable overhead cost per day, and the other is at 96, ICU's at 236. Assuming McCullough continues to use only one predetermined overhead rate, then we're going to calculate the predetermined overhead rate. So if we only use one predetermined overhead rate, what are we going to do it on? The total. The 17,200,000 divided by the 20,000 hours would be how much? 17,200. Do we have variable? Okay, but we have variable too. So we have to do the variable manufacturing overhead here. Let's see. Our variable overhead is 110 per patient at 20,000 patients, right? So if we do, how much is the cost again? The fixed is fixed overhead 200, 17,200,000. The variable was where is it? 110 times 20,000 patients, right? 110 times 20,000 or 220,000, 2,200,000. Our total overhead would be 1,940,000, and that based on the amount per day divided by 20,000 patients. Would that be 970 a day? Does that make sense how I did it? We took the total fixed, the total variable, we added it, divided by the patients. If we're doing a fixed rate, 20,000 patient days, that would be 970 per day. Okay? So how much would patient A, the total cost for patient A? If patient A had 4,500 of material, 25,000 of direct labor, and 14 days, then won't we want to take 45, 25? We'll take direct materials. Sorry, trying to figure out. Let me just. Well, I'm going to just go down here. So 4,500 were direct materials. 25,000 is direct labor. 14 days times how much was the amount? 970 a day. Would our total cost for patient A be 43,080? Does that make sense? How we're calculating that based on a plant-wide. 43,080. For patient B, we've got 6,200, 36,000, and 29 days, right? 62, 36,000, 6,200, 36,000, 29 days times 970. I'm sorry. 28 days. So 28 days times 970. What am I doing wrong? 6,200, 36,000. They want us to do this, not use just the 21. I got to see what I'm doing wrong here. Oh, this includes ICU, guys. The 21 days includes ICU. I'm sorry. I didn't pay attention. I know. So this amount would be 62,570 for patient. Do you see the 21 says total number of patient days including ICU? I know. So This is 62,570. Now, the predetermined ICU overhead rate, how will we calculate that? Wouldn't it be the 3,200,000 times the 236 times 2,000, right? The fixed is, how much did I say? 232? No. The fixed is 3,200,000. Lot of difference. 3,200,000. The variable is $236 times 2,000. And then if we divide this divided by 2,000 days, we would get $1,836 predetermined rate for ICU. Okay? So it tells us here the ICU is a fixed rate of 3,200,000. The variable rate is 236 times 2,000 days. You total those and you divide it by 2,000 patient days to come up with the 1836. Okay? Then they want us to do the other overhead rate. That's going to be the 14 million, and then the variable's 18,000 times 96. 14 million and what was I saying? 18,000 times 96. And then I take this divided by 18,000. Should it be $96.78? Doing something wrong here. $15 estimated overhead. We've got the 14 million, right? 18,000 times 96. 14 million. This should be 18,000 times 96. Okay, that looks more like it. That looks like it's 873.777 or 873.78. Right? Makes sense? 873.78. Total cost for patient A, if we use them specifically, then patient A is going to be the 4,500 plus the 25,000 plus 14 times our rate here of 873.78. Which should total $4,500, and I said 25,000 direct labor. The 873.78 times 14 days. This one should be 41,700. 32.92 or 733. 41,733. And for patient B, we've got 6,200, 36,000. In the, he's got 14 days in 7 days in ICU. So 14 days in 873.78. And then in ICU, the rate is $1,836. So we've got here 7 days times 1836. We should have 67,285 cost for patient B. Okay? Is that making sense? Let me just see what else. We've done a couple of these. I think the one thing that we didn't do was an income statement, but I think you'll be able to get by with that. If you need help, what is the use of unused capacity during the month? Let me just, so it's predetermined. Prepare income statement. Attempt to do that one. If you need help, I can work with you guys. Okay, guys, that does it for this